Welcome to the Valuation Desk by Highland Global, where SBA business valuations speak bank. Today, let's dive into a topic at the heart of small business acquisitions: asset sale versus stock sale. Both can transfer a business from one owner to another, but the legal, tax, and valuation consequences are worlds apart. For lenders structuring SBA 7A loans or buyers negotiating deals, understanding these differences isn't just helpful, it's essential. Let's start with the basics. In an asset sale, buyers pick and choose which assets to acquire, sometimes taking on specific liabilities too. The legal entity, whether a corporation or LLC, stays with the seller. This gives buyers a fresh start. They might acquire inventory, equipment, customer lists, or goodwill, but they can leave behind liabilities like unpaid taxes, lawsuits, or bad contracts. Here's the catch: assigning contracts or licenses one by one can get tricky. It often needs third-party consent. So it's legally cleaner but logistically messier. Now, a stock sale works differently. Buyers purchase the ownership shares, stepping directly into the seller's shoes. They own the entire legal entity, assets, liabilities, everything known and unknown. This keeps things like customer contracts, employee agreements, and licenses intact. But buyers also inherit all risks, visible and hidden. That's why due diligence in stock sales is non-negotiable. Now let's shift to taxes, a big driver in these deals. Asset sales often favor buyers. They get a stepped-up basis in the assets, meaning bigger depreciation deductions and better tax treatment down the road. But for sellers, especially in a C Corp, it's painful. They might face double taxation, once at the corporate level, then again when proceeds reach shareholders. Stock sales, on the other hand, are kinder to sellers, particularly in S-Corps or LLCs. Proceeds are usually taxed once, at capital gains rates. But buyers miss out on the step-up in basis unless they make a special election. So each side has different stakes. Let's explore how these structures affect valuation. In an asset sale, appraisers value the enterprise, the asset side of the balance sheet, which includes tangible assets like equipment and inventory, plus intangibles like goodwill. Cash and receivables are typically excluded in an asset sale. In a stock sale, appraisers value the equity. A buyer of the stock gets all of the assets and all liabilities on the books as of the valuation date. For SBA 7A loans, valuations typically rely on the capitalization of earnings method. For an asset sale, the appraiser will likely use free cash flow to the firm and the weighted average cost of capital. For a stock sale, the appraiser will use the free cash flow to equity and the cost of equity capital. Here's a crucial point for SBA lenders: debt in stock sales. Imagine a company with $500,000 in debt on its books. In a stock purchase, that debt stays with the company if the stock is sold, as it's part of the pre-transaction balance sheet. If the buyer uses SBA loan proceeds to pay off that debt at closing, the old debt is gone, but it's replaced by new debt to finance the deal. In this scenario, pre- and post-transaction, the company has debt on the balance sheet. The debt service impacts cash flow to equity and thus impacts the valuation. Here's the takeaway. Under SOP 5010-8, both asset and stock sales are allowed. For asset sales, valuations cover only the acquired assets. For stock sales, valuations include everything: assets, liabilities, and risks. A clear, accurate balance sheet is critical, especially for stock deals. Asset and stock sales both get deals done, but their legal, tax, and valuation outcomes vary widely. For lenders, buyers, and appraisers, knowing these distinctions is essential for informed decisions. When reviewing a deal, clarify what's being sold, what's excluded, and how it impacts the numbers. It's critical for SBA loan decisions. Thanks for joining us for this episode of the Valuation Desk. At Highland Global, our depth of experience ensures that your appraisal isn't just technically sound. It's contextually accurate, SBA compliant, and thoughtfully reasoned. We've prepared thousands of business valuations, and we understand the details that make or break a deal. Because in lending, it's not just about the math, it's about the judgment behind it. For more information on other valuation-related topics, be sure to visit our website, highlandglobal.com. Lenders know, experience matters most.